Hey, Gavin, can you hear me okay? Let's see. Let's get Mike T on here. One second, guys. Sorry, just trying to make sure that he knows where to be. Gavin, I'm coming for you. One sec, buddy.
We can hear you.
Okay, good stuff, good stuff. I was gonna try something a little different, but we'll just stick with the spaces. I was gonna try to live stream it, Gavin. That would have been fun, right? That would have taken a little bit too much technical details out of both Mike and myself on a Monday night.
I didn't even know you could do that.
Oh man, uh, yeah, you can. All right, hold on a sec. All right, guys. Sorry, we're looking for the man of the hour. I just DM'd him, so he should be coming. Oh, here we go.
There he is.
Here he is. Here he is.
I'm totally not coming.
I mean, given the fact that you basically spearheaded this thing last Wednesday anyway, so now it's just like a whole platform for you. This is the Mike T show. No, no, I'm just kidding. But thanks for making yourself available, buddy. You're an absolute amazing team member to Hedge Nation, and we're lucky to have you, Mike. So thank you again for
I'm
coming
so
on.
glad. Thank you. Thank you for having me very much. I'm so glad that everyone's learning so much.
Absolutely.
I remember Keith was in my office when he had this brand new product. It was we actually met when I was at Diamondback,
Okay.
and I think it was in it was either 2008 or early 2009, and I was one of his first clients, and it was great. I mean, it is great, and I really loved what they were doing, and I used it ever since. And I'm just so proud and happy for him that he was able to pull this off, because it's basically everything that Wall Street isn't. And like, Wall Street is like a necessary evil. Um, it is, in that they sell paper. They make sausage, and we have inflows, and we have to buy crap, and they make us sausage to buy. And a lot of the sausage that they make is garbage. Also, a lot of it are Google and the companies of tomorrow. But there's an awful lot of garbage in with it, and so it's sort of a necessary evil. But the research analysts is, like, for the most part, just absolute compromised garbage.
Yeah.
And it's upset me so much over my career that these people, the research people, the sales people, the banking people, are often knowingly selling total shit to the people and saying strong buy and putting people's retirements into total shit. And they look, they don't, their view is like, if it goes up, it goes up. I don't know the difference. So we just sell whatever, and that's it. And so I get it, but there's an incredible number of losers in the mix because they're just mom and pop. And I've always felt, because even though I wasn't associated with them, I still felt culpable being part of that Wall Street bubble and supporting these, I mean, evil twits.
Yeah.
And Keith came and represented something that was not. And I wanted to be all in right from the get go, because even though I was a part of it, I hated it. And so with his his bright, shining, gleaming light of hate, he could, elucidate the universe to the masses, and he did, and he has, and now it's really getting traction. So it's very exciting.
Yeah, I mean, once again, yeah, Keith's listening in, and I think you let off your investing summit call with him in a similar light, and he didn't have many words to follow, so I'll just kind of leave it at that, and completely agree, right? And as as one who's been on that other side, and it's true, right? Sometimes you got some real shit paper that you got to try to push onto your clients, and it's not fun. It's not fun to be in that seat, especially when you have a moral compass like I certainly do, and many here do as well. And it's yeah, you can kind of be between a rock and a hard place, right? Because you gotta, yeah,
It is, and you don't have a
yeah,
choice. It's your job, and you're like, and it depends where you're at,
completely.
right? Like if you're at Goldman Sachs, Morgan Stanley, or some of this other stuff, it's probably like 70%
Yeah.
okay. But if you're like Jeffco, JP Marlin, um, you know, it's just a ripoff
Yeah.
shop. But that's the job, and there's a lot of money in it, and people want to buy it, even if it is dog shit. So you give it to them, and I guess that's okay. I guess I'm just a little bit thin-skinned about it because, my dad, he still has a stockbroker at Morgan
Hmm.
Stanley. Okay, it's been like literally 45 years. So in fees alone, he has given half of his wealth to this
Right.
guy.
Right.
And he'll have all these like ridiculous, and my dad will call me and he'll be like, "Oh, Mike, what do you think about this? I think the chart for, blah 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 looks good here." And I'm like, "Dad, what are you doing? Stop. Just like do what I say." Still doesn't take my advice. By the way, yeah, exactly. Doesn't take my advice. He has never picked a stock that I told him to own or anything. Just still, I'm just like a little
So,
retard. But I'm not allowed to say that anymore. So
so unlike most of the people on this call, he does not have
anyway,
so
so
unlike most of the people on this call, he does not have PCT in his portfolio. But no,
no,
but,
well, I did tell him that he has to buy PCT,
there you go.
but I don't even bother
No,
anymore,
yeah.
because it's been 20 years of this. And I guess all dads are exactly the same. It doesn't matter how good I ever become at anything,
Hmm. Well,
Like for instance, I'd be
it's
like,
like it's
"Hey
like
dad, I just won the gold at pole
right.
vaulting at the Olympics."
Right.
And he'll turn to me and say, "Yeah, but did you win at the Special Olympics? Huh? No, I'm sorry." So
Exactly. Or you're driving your car and Max is telling you how or you're trying to tell Max how to drift, right? When he gets to be 16, you're like, I've been driving since I was 12 or whatever, right? So it's funny. But no, but
It's funny side note. Max is he's
14,
14
okay,
years old.
sorry.
He's going into Formula 4, so F4 race cars,
That's awesome.
and he's doing a testing day. He has never driven a car in his
That's
life.
awesome. That's so cool.
First drive in a car will be in a race
Yeah, I
car.
think
Like, all
I think
right,
I think I
okay.
mentioned this, or I think I responded to one of your tweets a couple weeks ago, and it's so cool seeing you share those photos. So I mean, it's so neat seeing kind of being part. Again, I've never been to a kart track or anything like that, but it's super cool watching Max grow and develop. And I know, yeah, it's just been really neat. So Mike, thank you for doing that. It's and putting that
I'm
out there.
so
Yeah,
glad that I'm so glad that people enjoy it because sometimes you just got to break up the monotony
completely,
of all this financial shit,
completely.
and because it's
Yeah,
overwhelming. It really is, and it's a great distraction because it's incredibly intense, it's brutal, it's violent, there's a danger, and it really takes my mind off it when I'm out on the road with them. So I really, really enjoy it. It's one of the few things that can tear me away from my phone
right.
and stuff.
Yeah, I
So
mean
I
that's
like.
actually a great segue, Mike. If you don't mind, I know you talked a lot of sort of some of the uh, I guess intricacies of what you're seeing out in the market right now with Keith this afternoon. So my thought for this call is a bit more of not kind of repeating what you've already said, right? So, folks, if you haven't watched the interview with Keith McCall at Hedgeye, I definitely would highly recommend it. It's about 45 or about 55 minutes, and it's all free. You just go to their website, and it's there for a listen. So he went through. a number of his own, kind of like the PCT and a number of other, healthcare related kind of individual names, as well as sort of the macro setup. My thought, Mike, tonight was a bit more maybe process oriented, right? As a good Canadian, we'd say it process, although Leslie loves to, but just kind of that balance, right? So, and again, I said it's a good segue because I think it could be helpful just to going into a bit of the balance, sort of like, you were just talking about how the sausage is made inside of, kind of inside of a sell side shop, but how does the sausage get made kind of inside of, a troglodyte's head, or kind of, again,
How did I do it?
yeah, yeah.
So, well, it's actually pretty simple. Um, it starts off with a story, and the story is usually a space that you're interested in. And it doesn't matter what it is. You're just interested in a space, and I was interested in healthcare. That's what I did. And then what it turns into, though, over time, is you learn more stories or more soap operas, and so it's like different stories that get intertwined, and then over time, it's a much larger story. And so every day that you were checking in and looking at all the events that happen, it's literally just a soap opera unfolding of agony and frustration and fear and greed, and over time you can really start to assimilate the policy with the politics and the numbers, and get an idea. If you last long enough, you get an idea. You see everything happen, and then you get to say, okay, I've seen this before. Is this going to be similar? And and really, it's like a game of attrition, where if you survive long enough, you get to learn a lot. And the whole key is to be in the chair and survive so that you can learn. And that's kind of how the grand process starts. But it always starts small. Like for me, it started with biotech names. So
Yeah, and right. So it was biotech, and most recently, you've obviously, moved on or moved over to launching Pink and the healthcare side of things as well. So, again, congratulations on that. Yeah, Gavin,
thank you.
question's yours, buddy.
Yeah, no, I was just going to say, Mike, you just said something interesting there, answering Robert's question. But how do you survive? I think you've talked about this maybe a couple times on Hedgeye before. But what are some, like some bigger rules that you have in place? You talked about it a little bit today, but how did you survive so long or
Great
stay in the
question.
game?
Really, it's the first 3 years. The first 3 years, and you have to be. I mean, look, I so when I started working, I was an analyst, and I became the head of healthcare at Oppenheimer Funds, and this was around 2001. And that isn't as hard as like a hedge fund, but it was really hard for me because I literally didn't know anything. And so they look, I didn't even know biotech stocks, honestly. I just got lucky in that they didn't have a lot of scientists out there on Wall Street at the time, and I didn't even know that. I got an internship. It turned into a job, and I knew a bit about virology. And I got them neck deep into this company called Gilead. And Gilead went from like $1.5 billion market cap to like 50 billion market cap. And so they thought I was like, so I was just kind of the right guy in the right place. And then they thought I was like way more capable than I was, and they ended up making me the head of healthcare. And I didn't know anything else about healthcare except like biotech drug stuff. I didn't know how end markets worked, how pricing was. What I didn't even know how an HMO worked. I didn't even know what an HMO was. That's a health maintenance organization. You all get your healthcare from them. I didn't know how hospitals worked, but they basically stuck me in the position to be like the hot ticket because I had all the good biotech stocks, whatever that meant, right? And so now it's you basically fake it till you make it in the very beginning. And it's always like that because they expect you to know way more than you do. And so then I worked, 6 days a week. I mean, I was the only guy in the office on the weekends for probably 8 or 9 years. from going there to hedge fund and stuff. And you always feel inadequate because you always know that people know way more than you do, and you have to compete against them. And so I just had to work and work and work. And so you need that. You need an insatiable curiosity. You have to be a betting person who wants to bet on it. And most importantly, in your first 3 years, you have to have an element of luck. Truly, because if you have a string of Six Sigma events, let's say 5 bad things act against you by chance, you could be out of a job and it wasn't your fault. So you have to be able to angle yourself to survive the unexpected. And it's very difficult to hedge against the unexpected because it's unexpected. So you do need an element of luck. And I was very fortunate to have all of those things. And then I learned the healthcare space in the span of a year or 18 months, and just I did well at it, I guess. And it was basically, whenever anyone ever gives you a task or a responsibility, the answer is always yes, no matter what. Even if you're completely outgunned, outmanned. You just want to give me the gun and throw me in the foxhole. I will figure it out. And that's kind of my approach. I would never, ever, ever, never say no, ever.
Yeah, there's a great member of Hydra Nation. He's a Jedi caffeine addict, and I believe you've interacted with him. But one of his favorite sayings is just show up, right? You got to be the guy that shows up. You got to show up in the foxhole. You got to say yes. You got to raise your hand. Whether it's a bar fight or just being next to somebody grinding across some numbers and trying to get to the right answer. It's just about showing up, and it's a huge thing. And going along your lines of work ethic, I don't know when it came onto Disney Plus, but The Man in the Arena, which was the Tom Brady, I think it was on ESPN Plus at first or what have you. Anyway, Disney, I noticed it over the weekend, so I watched the first few episodes, and the work ethic is one of the things that you know definitely has come across to me in the first 4 episodes with the Patriots, especially, right now it's kind of like the early 2000s. I just got to the Randy Moss episode, but that was, again, just kind of, you're spitting out that same message, right? Which is you're going up against guys that maybe, again, I don't know, again,
Oh,
not that
they're
it
better
matters.
than me. They were
Yeah, just like,
way better
right,
than
just
me.
like, again, it doesn't matter the say the where they went to school, but it's just more about just they were potentially better than you, right? So one of my favorite ones was the Pats versus the Colts, right? And the Colts basically had all the number 1 picks with Eli Manning and all a bunch of the team, and it was like the white uniforms versus the Pats uniform, and it was just that dynamic, right, where they just came at it with a much grittier attitude, and being able to outwork somebody and even chirp your own teammates for not putting in the work ethic, right? So, one of my favorite lines was, Brady got to the gym or for a workout session at like 6:30, and Vrabel was like, "Oh, I've been here for half an hour. Welcome, you're a little late here, Brady," right? So it's just those type of things, which I think is invaluable, and without that work ethic, and Gavin's got a hell of a work ethic, which is, again, congratulations, Gavin, for making the move. And it's 4 years of that work ethic, and here you are moving on to being a PM.
There you go.
It's absolutely unbelievable, man. So congratulations again.
Yep. I recently did an interview with, I think it was Mike Green, and he asked me about how I got my PM job, and I went through it with him. And everybody's, well, in getting a hedge fund, usually at least at that time, getting a hedge fund PM job was always a very strange progression every time. Basically, my boss wanted to fire me because he wanted to keep all my bonus money to himself. And he tried to get me fired by the partners, but I made so much money for the firm that they said, "Well, Tony, why don't we make him a PM instead?" And then Tony came to me the next day and he said that he really put in a good word for me, and he pitched to make me a PM. instead of firing me. And I didn't find that out until about a month later. One of the partners told me what really happened, and that's what it was. That's how I was going. How I got my PM job was that my boss went to fire me, and the partners decided that I'd be a great PM, and so now they had access to me because Tony was firing me, and that was it. And that's how I became a PM. Totally didn't know it, and I just got super lucky that because the alternative was I would be fired and he would have kept $3.5 million of bonus money. By the way, he kept $1 million of it to himself and then and ripped me off and didn't pay me. And he said that if I told anybody, he'd blackball me from my PM job.
Wow.
So and later that year, my son was born, and Tony bought me a Lionel train set as a gift. He's a strange guy, right? He'll steal $1 million from me, but then give me a Lionel train set for my kid. So
Right.
every year, every single year, I set up that Lionel train set with my son, Mr. Max, under the tree. And I always tell him, you know what that is? And he turns to me, he goes, "That's the $1 million train." It is. I have $1 million Lionel train set under the tree. So
Probably the one and only. Probably the
it
one
is
and
the
only.
one and only. One and only. That's the one I regret. I have a tremendous regret though that I didn't go to the partners and tell them what Tony did, because they would have fired him on the spot right there. And that actually would have saved their funds, because later that exact year, unbeknownst to me, he executed in some insider trading with some a friend and some lawyers that had some access to information, and 2 years later he got nailed for it. I didn't know about it till 2 years later. I had already left the shop and went to Citadel, but that was the final straw that took Diamondback down. That guy. So had I gone and come clean and said that guy took $1 million from me, here's my contract. He lied. He took the money and said he'd blackball me if I spoke up. Had they fired him right there, the firm would have been saved. So I actually did a disservice to the firm from protecting them from a douche like that. So anyway, that was my story on how I became a PM. And my first full year of a PM was 2008. So,
Talk about getting thrown into the
yeah,
fire, right?
it's like, yeah, I finally sit in the chair and I'm like, I'm winning. And that was but I finished up 4% in '08, and really I wish I knew a fraction of what I know now about how the world works, because I knew nothing. I mean, I have an MBA in finance. I got that before I went to Wall Street just so I could learn what finance is. And what I learned is that finance is it's well, it's in a book, and this is how it's supposed to be, and that's nothing how it is.
Mhm.
So basically, if you get an MBA, they're teaching you how they think things should be, but not how things are at all. So, and anyway, you can only learn what it really is being a keen observer of what's happening. And I think that I'm dead right in saying that the Fed mandate is a bunch of lies. Because, for instance, the BOJ, Kuroda, and Draghi, they had the similar mandates too, but they never, ever, ever, never, ever follow it, because their true mandates differ from their stated mandates. And all of it, everything else is just an illusion for the public. That's what I learned is the most important thing over the past 20 years is the illusion for the public to control a narrative very tightly so that people don't actually know what's going on. And it is extremely well and tightly orchestrated.
Keith, I think you came off mute. Did you want to add? And welcome.
Well, thank you. And you guys,
Wait, is Keith on this? Is this
Keith's
McCullough?
this is McCullough. Yeah, absolutely.
Oh my God.
you guys are listening to, to one of the great pros in this game. And Mike, but the question really is, who is the next? You and I are old, man. Like, who's the Mike Taylor of 2008 that is being born now?
Kishan Mehta. He runs a healthcare fund. He's brilliant. He's genius. I think he has the best numbers. He launched 2 years ago.
Where was he?
He was at Citadel. I helped him get his first job there, and I tried to hire him for a decade. And he's an alumnus emeritus from Critical Mass. So Kishan Mehta and my guy who worked for me, Terrence Lee, Tiberius Lee. I call him Tiberius because I've seen him tackle some ladies late at night in dimly lit bars, and he will truly go where no man has gone before, just like James Tiberius Kirk. So anyway, that's why I call him Tiberius, and I always introduce him as so. But those two guys are immaculate superstars. Terrence has a sharp ratio at Millennium that beats mine. He has a sharp ratio, career sharp ratio of 4, which means he's down 1 month about every 14 months.
Wow.
He's unbelievable. Kishan's the other way. He swings harder like me, and he runs a fund called Averill. And his first year out the gate, he's up like 210%. Last year, he finished up 10. And this year, he's up double digits. And I won't talk about this month, but it's a smoker. So he is unbelievable. Those are the two that I know of that are younger. They're in their 30s, and they're going to be, they're going to be superstars. I mean, they are superstars. So, but I don't know any new brilliant PMs that are pulling, plus 20% years in a neutral model or more, year in and year out. I don't know any. They're just so few. They're incredibly few. That just doesn't happen.
So one thing on that, Mike, is we could have talked about this for an hour today. I mean, what makes them different? You have seen and mentored many people who have not made it, and fewer people who have. What are the differentiators so that everybody can understand that?
You need 2 things. Well, actually, that's fascinating. I believe it. I won't say who, but I was just talking to somebody in Viking today, and we were talking about just this on hiring people and who and how and what. And you need somebody with about 140 IQ, and that's not terribly rare, by the way. You can't take somebody with 160 IQ. And we give IQ tests to everybody, because people that are super duper crazy smart tend to have a bad emotional IQ. They can't read people. So you need the ability to be very smart to process things quickly and a lot of information. But you also need the ability to know when somebody is lying to you, but not let them know that you know. So there's game theory, a little bit of poker, a lot of poker in doing that. And when I say somebody, I mean management of companies. And that's a really hard skill that I had to learn over time. Because honestly, when I started, I didn't know that people were I didn't know that management was allowed to lie to me. So I learned that quick. So, yeah. So you need this bizarre skill set of all of those factors to do well. And something that's unbelievably important is that once you figure something out of what's probably going to happen, you can't put the bet on. You have to figure out when everybody else is going to figure out what you figured out. And then you can put the bet on. Because if you're early, you're wrong.
Yeah, so right, you mentioned that in briefing this in your conversation with Keith today, kind of, time. Basically, it's comment on timing, because you said if you're early, you're wrong, and you're obviously also like, don't be right, make money, which is one of your favorite
Well,
sayings.
I try to
But the
live by it,
timing,
but I don't always get it. It's not
yes.
like I always get it. I don't.
So from a
Um,
timing standpoint, what helps you get, again, I don't know if it's, just layering on another level of patience, or what, but yeah, so kind of like, what helps you with the timing piece, in
the
terms of,
timing piece is that you have to be very disciplined. You draw the bell curve on your whiteboard, like I have. You put 100 in the middle. That's his median IQ. And you have to always try to figure it out. Like, okay, just remember, I'm here or we're here. They are there. When are they? What is the data point that's going to make them figure it out? And that's what you're trying to go for, is when are they going to hear the data point that changes their decision tree? And that's really, really hard to get, and you almost never get it right, but you try to get close. And if you can get close, then you can layer your money and your bets correctly into a sequence. So I would always have a whiteboard with 4 quarters up, and at the top each quarter, and then I would have events that are going to happen in each quarter, and I would be constantly watching the stocks, knowing frequently what probably was going to happen on this stock in this quarter. And I'd be looking for when they start to figure it out. And I could sometimes see it in the stocks. I'm looking at volume, I'm looking at technicals, and it used to work a little bit better because there was more active managers before. Now it's a lot of passive managers. So you see huge sector moves now, really violent sector moves, which are horrifying. And I talked about that a little bit today with the pharma move that just happened this year. And I just bought a F ton of puts in pharma on Friday. So it looks like I got it. And the reason why I put it on is because my trader at Millennium, so I'm still very close with them. He basically sees every book in the kind of the world, but he doesn't tell me what's in the books. It's not that. He has a great feel for what the vanilla guys are doing. And he was telling me, no, Mike, you can't do that now because um, because they're still there. They're still not equal weight. They have to get there. But when you see these wildly vertical, exasperated stocks where the hedge funds have all thrown in the towel, stock, garbage pharma names are up 25% on the year in a straight line. And you just look for that crescendo on diminishing volume, which Keith could tell you about because he watches it very carefully. And then when I see that, I'm like, this is probably the moment of exasperation from a single direction, and this was to buy. And so I'm going to take a stab. But as Keith mentioned, my stabs sometimes are pretty large. Or what I did is that I found options trades that were so cheap that I was basically betting, 80 basis points versus, so if I was $100 stock, I'm paying 80 cents to put on that entire bet for 2.5 weeks. And if I can do that, knowing that I'm close to the point, I'll do it. And
yeah,
I'll do it in size.
you mentioned basically long calls of Carnival Cruise Line, CCL.
Yeah.
Well, because of your catalyst, and I'm assuming it was probably, you had the Delta earnings in one of those quadrants there for Q2. So is that kind of one of you, so you'll kind of assess from a timing standpoint what's on the board. So when you're sitting, so I guess my question is, when you're sitting in early Q1, right? We're going through the first instance. You were kind enough to come on. I believe it was back in early January, almost 3 months ago now, and we had just sort of gone through that first kind of initial drop in January, and you were talking about basically, super cheap QQQ put options, et cetera, et cetera.
Mm-hmm.
So when you were looking at that, it's like, again, not to go back in time because now we have to play the game that we have today. But when you were looking at that horizon and you had those puts on, what was your like? Was Delta on the board at that point, or did it come on post sort of like
No,
the Russian
Delta
invasion? And
just came on.
Okay.
I mean, look, leisure and travel are killing it,
Yeah.
and their stocks are in the goddamn toilet because the vanilla guys don't care. They don't care because it's not enough market cap to matter.
Right.
So all that they know is that cyclical and typically consumer and all those things get killed in a rising interest rate environment. Um, and so what they're doing is just selling all of that and buying defensive. But the problem is, which they may not know, which they definitely don't know, is that these companies are going to smoke it. But it doesn't matter because it just doesn't play by their playbook. I mean, I'll give you an example. I was bullish on Spirit Airways for a long time. Save, I lost millions in it. Okay, and and I'm going to say a dirty word. Are you ready?
Let's do it.
I was right. Spirit Airways just got taken
Yeah.
out, and with multiple offers,
Correct.
way out of the money. I
Correct.
was like, "This is insane." That's why it was so huge. And guess what? I made no money. I lost money. So, and that was because I was trying to be right, and I'm an idiot. See, so I got it right, and it didn't matter. It's still a performance piece of crap. Even with this takeout, it should be stock would be a double. But we're in the wrong space for that right now. So there's always that battle of being right versus making money. And the worst thing is that where you're dead right, it gets taken out and you still don't make money. Oh, what an idiot. So I make mistakes. I make mistakes. But like for instance, in Delta, well, now we're going to start seeing the earnings, right, and the forecasts. And so the vanilla guys are going to have to take note. They will react after the event because their playbook basically says all these things are going to suck. We're going into a recession, but it's not. They're actually going to be really good. And so the hedge funds have basically like thrown in the towel and all this stuff. They're just killing themselves because they're all trying to be right instead of making money. And I know a lot of them, and they are just they're down double digits on the year. And these are smart guys, really smart. So smart. For instance, I'm an investor in their hedge fund and double down on them because they're down. And I've known these people for like 15 years, all the way back to Citadel, and they're brilliant, and they're getting their faces ripped off because they're used to being right and making money, and it's not working. So what I'm thinking about is, when is everybody going to figure out the Carnival Cruise Lines and most of the cruise lines are huge buys? Well, it would actually probably be on Delta's quarter when everybody figures out that things are way better in travel and leisure than anyone thinks. So I look for a really cheap way to play Delta, and it ends up being Carnival, who isn't reporting, and the options were dirt cheap. Unlike Delta, ever there's a vol in him because they're reporting on Wednesday. So what I found was a highly correlated surrogate at a very low price. I mean, I think I paid like 40 cents or something, for something that was in the money or at the money. And like, did I close in the money? I don't know. I got to take a look and see exactly how it closed. But anyway, so I'll do that. And it didn't cost me much. It cost me very little. But it basically protected me from a squeeze play in the market. If, for instance, the CPI comes awful, stock market goes down, and then it just starts ripping back on short cover, I'll be hedged with that. And I'll have alpha behind me because Delta is going to be good, and I didn't pay for it. So
Exactly.
I'm
No,
always trying to do that.
I think
And
that's a really important concept for the folks listening to really kind of comprehend, right? Because I mean, you're looking at this. I mean, you're basically playing. Yeah, like, I don't know what's beyond the 3D chess, but you're playing whatever that is. You're playing 3D chess on steroids, because you're managing your portfolio, right? Which today you said was about 40. I think if my notes are right, 41% net short, right? So you're net short. You're generally leaning in that direction, but then you
No,
get
it's 106% net short now because
now.
my put's finished in the money.
Got it. So yeah,
So
so you're balancing that on one end while looking at the events that are coming down the pipeline, let alone OpEx, later this week. and the kind of passive flows that come with kind of on the fifth, typically, this time of year, or sorry, this time of month, mid-month, and then the end of the month, and that kind of thing. So you're kind of looking across the board there. That's so fascinating. And just along those, sorry, I had to, where, so where else, like, because you went in a lot of places. I mean, you and Keith joked that you went kind of around the globe and did it so succinctly, and you really did. But where else are you seeing either opportunity or something that you really wanted to call out or spend a little bit more time on? And even if it was something that you did touch with Keith today, by all means, feel free to kind of elaborate on something. But just kind of curious if there's anything else out there that you're seeing similar to this sort of setup in leisure. And Coach, I think he's in front of his fractals. So if you have a back test, I looked it up on one of your maps, Keith, but we don't have like jets on there where we had XLY, but that's not really going to give us the what I need. So,
Well,
so
this shouldn't work in this quad,
right,
right?
right.
It shouldn't work in this quad.
But
It's
it's
just that
different every time, right? I mean, that's what, and again, every quad is different.
it is, but it shouldn't work in this quad, or during this like consumer slowdown, stuff like that. It shouldn't work. But there's a lot of factors at play that probably look. I may get a good squeeze out of it. It doesn't cost me much, and really, my game is essentially that Apple computer is going to blow up. That's my bet. Because if Apple has to take down for the year, and they very likely have to, I mean, like totally have to, this entire tape is going to get smoked because that's where all the money is. It's all on Apple.
Yeah, I mean,
And Microsoft, Google, whatever. But everyone, especially since Netflix and Facebook blew up, they just concentrated their money even tighter into those top four names: Apple, Microsoft, Google, Amazon. And of course Tesla. That's where all the retail money is. So this is what they own, and this is what they will sell. If any one of them blows up, they're all going down bad, and the whole market will go down with it. So that's kind of like what my real bet on the market is. Truly, when I break it all down, I am truly betting that Apple cannot make numbers, and I have no idea how they can. So, that's really it. And I basically have
pretty,
108% of my book betting on it. So,
yeah. I think it's pretty clear, guys. So yeah,
I asked Keith this weekend, if it doesn't work out, does he have any room in his basement for my small family? So,
well, it's a good thing that I guess he leaked on yesterday's show that he's building a new house somewhere very remote. So maybe you can mooch off that spot.
I'll get secret access.
Yeah, yeah, secret access, right?
That's right.
Yeah. Awesome. John, I saw that you had a question. Was it something on? And welcome.
Hey, yeah, Mike, thanks for all your help with everything. You guys are quite generous with your time and knowledge, and I appreciate it tremendously. My question was about options, and that's why I put my hand up when you guys were chatting just now. You talked today about how during the last run up, that rally that you had put on some size bets with kind of a longer duration. And I know Keith, when he talks about people putting on options trades, you fill up your position and then you kind of layer in some shorter dated stuff. I was just curious, is there a favorite structure that you like to use in this kind of market? Is it like risk reversals or spreads, or are you just looking for, high delta, high gamma? Like, is there a secret sauce that you kind of use for those bets that you're making? Because I've had a great first quarter. I've taken some money off of the table.
How much are you up?
I was up 9% year to date. Last I checked, which was last week. So
and
I was doing very well.
What was your view coming into the year?
It was the hedge eye view. So I was probably a little bit more aggressive, getting short everything. I got dinged a little bit on TLT, but other than that, I've been And so I had a couple great shorts. I caught a couple good blowups, Facebook, Netflix with
Wow.
options.
Wow.
Again,
Nicely
all
done.
using the risk ranges and just kind of having higher convexity trades on. And I got lucky, super lucky. So
No, you
again,
got
now
good.
I
You
pay
got
for a
good.
quality product. So my question though is that basically, now I'm trying to take some defined risk bets going into this what seems like a big downturn. Invitation Homes, Rob, I see on there. Thank you for that one. I have some bets out in July. I typically don't like to lug that much premium, but again, I'm just looking for some guidance from the gurus as to what you guys like to do.
Um, so what I've been using options for frequently is to lever up my book on a really big bet. So it'll be very directional. And I limit my losses by, doing something 15% in the money short or something. And I'm super confident in it. So I'll lever it up, and I'll do that with options. So that way I can minimize my risk and not pay a lot of vol for it. Once you're 15% or so in the money, you might be only paying 1%, 1.5% over at most. I mean, that's literally what I did with Apple. I bought the 185 in the money puts, Sizola, and then I bought more right here, 165 Junes, because they were super cheap when I put them on, because nobody gets the vol right on large cap single name stocks. They kill you in ETFs. They massively overcharge you on the options and ETFs, because that's what all the hedge funds will do. So it's really picked over and bid up, because the hedge funds, look, most of the hedge funds that do this, they don't have shorts. They literally have their favorite longs, and then they'll be short a whole bunch of ETFs. And that's why when the market goes down, they get absolutely destroyed. So on paper, it says you're hedged, but when the shit comes to show up, you're gonna be down 6%, and then you're near your stop limit losses for your entire book, and you're just collapsing everything just so you can have your chair still there and maybe take another stab at the end of the year. So I tend to do single name rather than ETFs, and I tend to try to have an angle in the name. And frequently, I'm really opportunistic, like how I traded, for instance, Carnival. I don't know if I'll make any money in it, but I paid very little to put it on. And so that's what ideally what I'm doing is constantly scanning on how to hedge what I'm doing. Um, that, like, for instance, for that V bottom, we had this V bottom. I talked to Keith about it too, I think. That V bottom that we had, a short squeeze. I figured out how to hedge it, and I thought what you do is you buy puts on Treasury futures, because they're much more liquid than the TLT, and that most retail accounts will trade. And so essentially, it's the same thing: puts on the TLT or calls on the TLT or whatever. But you're actually going right to the futures of the Treasuries and then options on that. And I figured that it was probably 5 to 1 that if we get a rip in stocks, the 10-year will sell off dramatically, and that would hedge me against that V bottom, because I was running pretty short, and it worked. And what I learned in trading these sort of interest rate futures or treasury futures, and options on that, if you make 10 to 1, 12 to 1, you book it. And because it rarely gives you trade, like if you take a look at this interest rate trade that happened, like, it's unbelievable, this sell off in bonds. It is just unreal. I've never seen anything like it. I made 12 to 1 and I booked it, and then I proceeded to lose 12% in my book overall because I booked it, because that trade went to 30 to 1 payout within 2 weeks later. And so I just felt like the biggest dope for taking it off and giving up 10% in my book. So I definitely don't get it right. But what I'm doing is working hard to find ways, sometimes exotic, to hedge my book. And that was one that I told all of my critical mass peers that I thought this is how it's going to trade. This will hedge your book for a V bottom. And it did. So, I'm so happy that it worked. It saved me about 12% of losses in my book. Of course, I proceeded to lose 12% once I covered it or closed it out. So, it's like, hey, I'm only down a lot. So,
That's amazing. Thanks for
I'll
the
share with you guys. I'm about plus 50 on the year.
Hey, Mike, on that point, within many points, like again, practitioner points, the super deep secret that you just revealed is that the masters of the former hedge fund universe really are pussies when it comes to shorting stocks.
Oh my God, 100%. Nobody ever got rich shorting stocks except Jim Chanos. And he only got rich on fees. He didn't get rich on returns. So, and no, don't get me wrong. I idolize Jim Chanos.
I mean, investings of it.
I believe, Keith, like it was the highlight of my career that when I had that call to buy garbage coming right off of Jim Chanos to me in 2020. First of all, I was coming right off of Jim Chanos. So holy crap, everybody was watching then, because everyone was on to see him, not me. And so everyone was still there. And it was, I shook his hand before. I didn't wash my hand for weeks, I idolize that guy. And having the opportunity to share a forum with him is just, oh my God, just truly the highlight. My wife is just like, who the hell is this guy? My God, he's so old, And I'm like, no, he's a god. He's a god, Jill. She doesn't want to hear it. She doesn't want to hear it. But it's an honor to be on a share forum with him. He is absolutely brilliant. And so the one thing that he gets, I want to say, wrong all the time is the timing. He comes on as soon as they figure it out, they put it on. And that is very dangerous on how he trades. Now, he's afforded himself the right to be right eventually. And frequently he is. But the pain that he must endure to get to that moment is, it's something. So, but it's really hard to get that timing right. And I guess his fund is so big that he doesn't have the liquidity or the time to figure out when everyone else is going to figure it out. So he puts it on immediately and then just gets bigger or massages the position. Millennium, I can't do that. Because if you're down, I had a huge rope. I was like, I'd only get fired being down 9%. All of my peers are at 7%. And that's in healthcare. That's really volatile. Like, for instance, an industrial or consumer book, it's 5 or 6.
Yeah.
And that's boy, you get 3 bad days. You get a short taken out, that can take you down for 2 right there. Just that.
Well, that's the brutal thing, is that a day like today, which you called out, we had this discussion on a live wire because you kept looking at your screen as only you would. And, the pain trade today was actually down oil, up crap retail.
Oh,
so you're sitting there, you're short DraftKings or Weber Barbecue.
Short both.
The world, and you're getting, jacked on these shorts. And it's so typical because last week, on the downside, XRT, which is a balanced ETF, it has like no concentration. So it's like a bunch of crap retailers. Last week it led on the downside when things weren't, when the smarter than you shorts weren't going down. So it's an interesting game, like every day, like the intricacies of what's getting squeezed and where the pain is. It doesn't, Michael, always find its way into the place that you least thought that it would happen quickly.
Well, we're seeing this like incredible dichotomy market where like the hedge funds aren't trading Apple, Microsoft, Google, Amazon, because they're so big and the correlations are so high that they just don't bother. So they go where they can get alpha. And so they pile into these mid-cap names. And so they are subject to books blowing up all the time. And it's like, for instance, if you look, I'll pull up like the short interest because I have it up all the time, um, Kimberly Clark, 2.6%, General Mills, 2.5%. Go down all the biotech stocks. You can look at all of them, and they're all like the short interest in them are between 5 and 30, all of them. And you say, well, who's short all that? Well, I'll tell you short of it. Citadel, Millennium, SAC, Balyasny. That's it. That's it. All of that short is just those shops and just the pod books. And those pod books in aggregate are gigantic. I mean, we're talking about hundreds of billions of dollars of capital deployed that isn't allowed to be down 5%. So you have everyone is on the panic trigger all the time. I mean, look what happened with AMC and GameStop. Oh my God, what a widowmaker. Do you remember when we talked about the garbage trade? And I remember you asked about AMC. What about AMC, as a garbage trade? And I said, even I can't get long that because they'd go bankrupt even if this didn't happen, COVID, and wrong. It was the best bet ever. Best one ever. It went from like 2 to 40.
So Lisa Hyatt, who's listening in, she just tweeted out that we're talking about our losses, but I'm gonna flip the switch there and say that was my best win of 2021 was AMC. Mike T, I owe it all to you because it was basically my cost basis was I think $1.98. And luckily, with key signals and stuff, I was able to get out at a very, very nice profit. But that was a hell of a garbage trade.
It was just killer. I mean,
Lisa,
truly,
I know we love talking losses, and I got plenty of those to talk about too.
It sounds like your middle
awesome.
name is Tiberius. So, because I couldn't do it.
Oh man, it was that was just a hope and pray. But
Robert, the second best trade for AMC is when they said, "Fuck it, we agree with the shorts. We want to invest in movie theaters. We're going to buy gold mines."
Exactly.
The stock went from 14 to 29.
I know.
I remember that morning on the call, and Freebird.
The Dirty Bird is on here listening in right now. It was incredible. I mean,
you remember that day, Mike?
Oh God, yeah.
If Freebird's on the call, that's the beauty of the call. You listen to the call, and some people don't get the call, but again, I'm like, that's the beauty of the call, is that the analysts will say something because Freebird's going all fundamentalist. This is like just like the street did. Oh my God, I can't believe they're investing in like something that's not core. I'm like, absolutely a great idea. Gold mine.
Yeah, well, think about it. He's going to be the new Warren Buffett, right? Warren Buffett with a furniture company, ice cream parlor, and he buys an insurance company, and then he just starts rolling up shit.
Oh my God.
So,
that stock went like almost 30 that day, I think.
Guys, you're missing. It's popcorn. The future is popcorn.
I believe it. I thought that when I saw that, I got a call from my very good friend, industrials guy that I work closely with, and also brilliant. I thought he was kidding. I thought it was like he was reading it from The Onion or something, like they bought a gold mine. I was like, that's funny. And then they really did. And I was just like, now they can screw up on that execution too. So, and of course they will. There's no doubt.
So speaking of things that may help the balance sheet, Amazon, right, and Rivian, and how that bad boy, and now that we've got couple hedge eye analysts on the call from not the Amazon realm, so we don't have Brian McGough, but Rob Simone, welcome. Thanks for jumping on to speak. How do you, Mike? Can you? I mean, are folks modeling like the Rivian shift from basically what was it, like 100 or 130, I think, on the something like that, 120 on the balance sheet to now, trading at 40, and what that might like? Is there going to be just as big of a headline, or does it only go one way?
Can you rephrase
Oh,
that?
sorry. On Amazon last quarter, how they had
Yes.
they had a huge beat, and it was primarily because of the Rivian.
Oh, they
the
put that in their, well, really? They put that in their beat?
Yeah.
They didn't back it out and say, this is our miss?
Correct. Keith, do you remember the number? It was a big one. I don't remember off the top of my head, but and if it's not something that you follow, then we can move on to another
Well, I
question.
follow
But
Rivian. I'm short Lucid.
okay.
Lucid needs to raise $6 billion yesterday. So
Yeah.
Well, I could tell you what the Amazon risk range just went to at earnings, which is a shit show. I mean, if we're bullish trend, Amazon and Bitcoin are the exact same thing, Mike. It's amazing that you made the point about Apple. Same thing. I mean, fully loaded, it's all the same. It's all the speculation associated with the former bubble that has clearly been imploding since mid-November. And now you just keep going back to chasing what everybody thinks they should know. And whether it's Amazon or not, I mean, Amazon basically told the street that, X Rivian or not, they're about to have the worst quarter that they've ever had. So now people, the street's sitting there saying, okay, maybe this is, if you saw this, Mike, did you see that JP Morgan's, the guy who's like the guru quant, he went.
Yeah, I know the team.
Yeah, Kolanovic, he went.
Yeah.
Really?
I talked. Oh, I won't say who I talked
way
to,
too
but I do talk to that team internally.
Like way too bullish, like this year, and now he's saying book gains.
Yeah.
From what? I mean, what the fuck do you have a gain in, Kolanovic?
Well, like, you can imagine that we had a very long conversation this weekend. So, and they, I mean, I just spell it out to him. I'm like, this is all happening before the Fed shows up as the biggest seller in the world. And I'm like, what is the upside? Like, at minimum, the Fed isn't going to blink unless the junk market goes blotto. If the junk market goes blotto, stocks are 20%, 25% lower first. And what's even worse about all this crap, when I go through the numbers, I have no idea how we're going to be sub 5% inflation by year end. So it means that they can't even blink. They can't do anything. It's the most convoluted, awful setup globally for stocks that I've ever seen by a mile. It couldn't, if you asked me to write the worst conditions, this would be it. And the war in Ukraine is just, that's icing. So, I mean, honestly, I didn't have a view. But the consequence on that war and how it's unfolding, and somehow how the U.S. got Germany to actually not cave to the Russians entirely and immediately, I have no idea how they did that. Because I thought Germany would be like, yeah, fine, you can have sanctions, but we won't. And in many ways they haven't. But a lot of the rest of Europe have just said, we're cutting off the Ruskies. I mean, Deutsche Bank is in bed with Putin and Trump, which is kind of weird. But like literally, Deutsche Bank is the dirtiest bank, second to HSBC and Credit Suisse. They're kind of all just as bad, but Deutsche that's big.
Did you see what? I mean, you watched because you always listen to Kyle Bass, but he was right before you on the investing summit. And by the way, just on Blotto, I just went Blotto on Twitter for you.
Oh, thank you.
I'm literally sitting
Oh
here.
my God, that quote you
I'm,
put out there, I
I'm,
forgot he even said that with
I'm,
the Fed
I'm,
is furnishing verbal diarrhea for the masses. Oh, Jesus Christ. I got to use that. That was good.
I mean,
What?
I'm just chuckling over here on mute between Keith's Twitter game and then Mike talking about Drew. I mean, talking about two different.
But uh,
But
back back to Kyle Bass. Mike, did you see the the link he made between ex-chancellor
Oh,
Schroeder?
Schroeder. Yeah. Well, I mean, yeah. Look, they're all on the skim, right? It's all the grift. This is why I said Ukraine has to win. They cannot not win because just imagine what the grift is going to be when everyone has to rebuild Ukraine. Oh, billions of dollars, billions and billions and billions of dollars. Oh, everyone's got, dude, we're going to have to call Hunter Biden back. You know, he's the inside man, right? I mean, it'll be everyone. Giuliani will be back there, right? Oh, it's so that's why Ukraine has to win because they need to rebuild it. $100 billion worth of shit. So
yeah, so
that
Mike, on that Amazon one, somebody other side just texted me. He said they announced a $14.3 billion gain with over 11.8 billion from Rivian alone. So it was a huge miss, but yeah, so that's what they're, and that was last quarter. So they'll have to.
I'm certain that they will report reformed non-GAAP results that do not include that loss. And when I say
Exactly.
certain, I am 100% certain.
Correct.
So
Correct. Yeah. No, fair enough. Fair enough.
yeah.
Awesome. Yeah. Simone, Rob, welcome.
Uh,
Thanks for jumping in, man. Yeah. Are you still down at the Bitcoin conference? That's like the longest conference I've ever seen. I don't,
no,
does nobody have a job down there? I mean, I don't, it's literally gone on for like, it feels like for 2 weeks. Like, I don't get it.
yeah, no, I'm back.
All
I
right.
was there for 3 days,
Got it.
but
Welcome back.
Can you tell me about I haven't listened to anything from the conference, but I'm just wondering how any speaker can have anything different to say than the speaker before them.
yeah, that's well. I mean, you know what they do? They break it up into different stages. So there's like one where the main stage. You know, they have like guys like Jordan Peterson and Jack Dorsey. Another stage dealing with energy and mining, so that they kind of carve it up by different subject matter. So then there's like a conference hall with like people selling hardware wallets and stuff like that. But yeah, it was interesting. I mean, it's definitely kind of a love fest. You have to like go into it with a skeptical eye. And
They used to have a cannabis one too.
Yeah,
not so much love fest anymore. I'm going to make a prediction. Bitcoin will be sub 10,000 this year, and Sailor's MSTR, Master, whatever they call it, is going to go to zero. He will have a margin call.
for what it's worth, I don't think the debt's structured that way. I think the stock could go
There's
to zero,
some new debt that is.
But he's over collateralized 4-1. So he used, even if it fell that far,
that would be 4-1.
4-1. Well, yeah, he'd be 1-1 on it, but then still have the cash flow servicing the debt from his software business.
Yeah, I think something can be called. One of my guys said so.
Interesting. So, I'd love to, if you have any details on that, I'd love to.
I will. That's my industrial guy. He's brilliant. He's like he said the recent debt that came out is secured to those assets, and they can call it. So
interesting.
I think, and now I'll get back to you on that because I'm not. It's not my thing, but I'm look. The Bitcoin, the crypto NFTs, whatever it'll be funny because once it goes to like $5,000 again, everyone will turn around and be like, yeah, well, obviously that was a bubble, but this is when you buy it, and that's what they're going to say. They're going to always look back and, obviously it was a bubble, but look, all debt is fungible. All leverage is fungible. And the most reflective of the direction of leverage in the world is going to be crypto.
Mm-hmm.
So, because
I agree with you for what it's worth.
Okay.
I think that, I maybe like a little more nuanced of a view I think that like the stablecoin backed DeFi space is really where you're going to see some spectacular blowups. And what's
You mean Ponzi scheme?
Oh yeah, totally.
Oh,
Like
yeah.
the thing about Bitcoin is it's kind of like in many cases it's a bearer asset where you take possession, whereas everything else is like literally a Ponzi in the DeFi space. So I don't disagree with you for what it's worth. I think you're right about that.
Yeah, well, anything that's not regulated and offshore is almost always a fraud.
I for what it's worth, I had a healthcare question for you, if you're willing.
Please.
So I'm taking a look at a hospital REIT.
Yeah.
And it's a company called MPW. And basically, like what they've done, they've purchased the real estate out of the hospitals, out of a bunch of hospital systems over the past, like, call it 10 to 15 years. And I guess my question is, do you have any like opinion on margins at the operator level? Like what the guys that are supposed to be covering the rent payments to the landlord in the case where they don't own the real estate and the REIT owns the real estate, like what does that operating business look like behind the scenes? The disclosure is like not that great if you look outside of HCA.
Yeah. I'm long Tenant, for instance, because Tenant has more than half their business is kind of an outpatient care. And so they're going to be able to turn the patients quick and survive. If you're not aware, one of the biggest costs to hospitals is staff, and the pricing now for staff is incredible. And the hospitals basically get a fixed cost per procedure. It's called the DRG. And so, you have a heart attack or whatever, and they get paid $10,000 from Medicare, and that's it. And it doesn't matter if the cost of all your nurses doubled.
Yeah.
So hospitals are in serious trouble on their margin.
Yeah.
Because their input costs of the people is too high, and it's going to stay like that for years.
Yeah. Yeah.
So I am not bullish hospitals. Also, about 2/3 of med tech are running into the same exact problem. For instance, like titanium hips and knees, the cost of those have gone through the roof, but they are only reimbursed at a DRG through the hospitals. And so they have no pricing power. And so they are going to eat it on margin. And I think that strangely, not so strangely, frankly, it's been the larger cap names that have greatly outperformed net. But it's been without respect to what's going to happen to their margins moving forward, because I don't think any of the vanilla managers have done any of the work on it, except that they've determined that pharma is better because pharma won't have those margin problems. And that's probably why we're seeing a big move to pharma. Like even in the pink book, I made a mistake of being long alpha med tech names that aren't going to have this margin problem, but it didn't matter. They all went down about the same. So while pharma went straight up. And so I really should have played just the dumb game and been like, I'm not going to be a stock picking genius. No, I'm just going to think like my IQ is 100. And that's what I should have done. And so I get that wrong too. Sorry, that's a long-winded answer to your hospital question.
No, it's great. And the reason why I bring it up is, like under REIT rules, when you have a triple net lease and an operator paying, basically supporting that lease, if the one operator trips over 30% of your rent, the SEC actually makes you disclose the financials for that operator as material in your 10K. And what's interesting is their biggest hospital system is Steward, I think, Steward Healthcare. And what they do is, so I'm not as familiar with this. You may know better, but they received essentially like COVID relief fund dollars in the form of revenue, right? And they book that as revenue, but then in their adjustments to EBITDAR with an R on the end, the metric that covers rent, they add back all the one-time COVID expenses to get to like a 2-4 coverage. So in essence, what they're doing is the operator is showing the revenue, but then adding back the cost but which is not apples to apples. Or it's an apples to oranges comparison. When you make it apples to apples, the coverage drops to 0.7 on their rent. And meanwhile, their occupancy, like their bed occupancy, has been flat, even like back to the beginning pre-COVID. So I suspect that their biggest operator may not be covering their rent. And that's why I ask you. And what that really means, based upon what you're saying, is with cost, that coverage should be getting even worse, if I'm hearing that right.
It's going to get much worse. I am expecting not good things for the hospitals.
Yeah, that's interesting. Okay, cool. Thanks for that. I appreciate it, Mike.
I'm not short any hospitals, by the way. So, and honestly, now that I think about it, I don't know why. So I should be.
well, it looks like Rob may have just found you.
I just have so many stocks right now that are zeros that that it's. I'm really trying to maintain a group of companies that I think are probably going to flirt with zero. I believe for this, once the Fed starts tightening, quantitative tightening, I think that financial conditions are going to lock up so fast as stupid in housing and commercial lending and you name it. I just talked to my commercial lender, and my commercial rates on lending has gone from about 5.4% to 7.2 in 40 days.
Yeah, it's funny, Mike. We actually getting back to the high yield. We actually had a discussion on the call this morning about this very issue. So, one thing that's interesting in the equity market is not sniffing it out yet for the single. You and I have talked about single family rentals. The spreads on single family rental ABS, so basically like pools of homes, collateralizing tranches of ABS securities, the spreads have blown out like 200 basis points over the last 2 weeks, while spreads on like multifamily has actually come in. And the equities haven't moved at all. So like Invitation, which we're short, full disclosure, AMH, Tricon, like they've basically been, neutral to the XLRE, but the spreads on CMBS that underlies the cost of capital, right, have been actually blowing out, which is interesting.
I just imagine what it looks like when the seller shows up every day.
Yeah.
For 80 billion to 100 billion a month. And I, oh God, and I was trying to figure out why they're doing it and not using the yields. And I think the financing the treasury is actually what explains it. The government doesn't want to finance at a higher yield unless they absolutely have to. And so the Fed's going to try to tank the economy with quantitative tightening, and they will be successful.
So, Mike, just along those lines, do you think you could just kind of expand a little bit on what you see with the Fed and again, just I know you covered it a little bit with Keith this afternoon, but just for those that didn't get a chance to watch that interview yet, that'd be awesome.
Oh, sure. So right now the government, the Treasury pays out like they bring in tax money and they have to pay the coupons on the debt. And most of the debt is financed between 1 and 5 years for the Treasury. And that started under Bill Clinton, actually, moving much of the financing of the government to the short end of the yield curve. And a lot of governments do that now. And so right now they're paying out 15% of the tax money that comes in coupons. And their rate that they're financed at is sub 2.5% on average. So if the yields go to 4.5% for, let's say, 0 to 4 years, meaning on the yield curve, not for that duration in time, but let's say that happens, it goes to 4.5% and it sticks there for 3 years. Well, then the government is going to be paying out, instead of 15% of their tax revenue, they're going to be paying out 25% of their tax revenue in coupons. And that means that they can't afford a military or Medicare or Social Security. And in order to afford that, they're going to have to issue even more debt. So then you get potentially a run on the dollar. and a run on the bonds. Because recall, we have to find about 43% of our treasuries are financed outside the US. So you have to find foreign buyers that believe the dream. And that will be very, very difficult when the government can no longer spend, meaning our GDP will be negative. We will be in recession, and the government will have nowhere to go to spend in their largesse without borrowing at higher and higher yields, because there'll be a run on the dollar. And that is the Fed's job. The Fed's job, not the Treasury's job. The Fed's job is to prevent that from happening. And so, just like Kuroda, who mission accomplished, you now have inflation. So now you can stop printing money. Wrong. You're going to print more money, which is exactly what just happened. The US is in a pickle because they can't turn around and print money to suppress the yield curve, because then you'll definitely not find the buyers of the Treasury, again, outside the US. So what they have to do is tank the entire global economy to find a buyer for treasuries somewhere on the yield curve, and I suspect it'll be around the 10-year. So there's going to be a moment in the not so distant future, in my mind, to be meaningfully long the 10-year, and it'll be after they start quantitative tightening.
Sorry, say that, or maybe expand on that a hair. Just there's a lot of folks, I think, that are still
Well,
battling
my
that
point is
trade,
that
right?
if
So
they tank the economy,
yeah,
right, if they tank it and yields go blotto and junk, right, and consumption crackles and our margins tank because we're at ultra peak margins right now, everyone is going to say, well, Jesus Christ, I'm selling everything. What do I buy? They're going to buy the 10-year. And we'll have a meaningfully inverted yield curve, but they will be buying the 10-year. And so yields will begin to drop in the 10-year as they're buying it. And as those yields go down, the Treasury can start selling their debt, financing the government at that 10-year level, maybe at 2%.
yep.
I expect us to have a very meaningfully inverted yield curve at some point this year. And that's where they can find that spot to finance the government instead of at 4%, but at 2.5 or 2, something like that.
Yeah, and Rob, since we still got you on, how does that impact any of the real estate side of things, like in terms of any new financings and stuff like that? Like, how are you reading that
Well,
through your space?
it's actually really bullish for that. But the problem is that the economy will be falling apart at the same time.
Right.
So
Yeah.
I'm not exactly. Well, it also might be this where it inverts, where the short end of the yield curve is at 3.5, and then the 10-year is at 2.9. Right. So it's helpful. It's helpful to real estate in that regard, but at that time, we're probably going to start having jobless claims lifting and credit problems everywhere. So yes, it would be bullish for real estate assets. But just not sure there's going to be anyone buying them. So
The only thing that I could think of, and I've kind of been positioning for this, what Mike just said. Think about like the longest duration triple net single tenant REITs with very high coverage. So basically the most bond like vehicle you could possibly get in REITs, such that, you're talking about like 12 to 15 years of lease term, very low leverage, and like 4 or 5 times rent coverage, and like a 4 to 5% yield. It's essentially like a tip, like a treasury inflation security. That's the only thing that might like not, give you like, a 30% drop, like the short duration stuff.
yeah, I've moved about 10 or 15% of my wealth into hard assets, single family rental units. And that's where I found an incredible amount of alpha right now. Because I think the rental rate equivalent is going to keep hiking and hiking and hiking, because it takes years to update your portfolio of tenants at a higher price. So I've been picking off properties off of distressed landlords because they've had real difficulty, and especially now because they can't finance anything. I just bought 2 more properties this week, and once we're done, now it's very capital intensive. I'm walking in with all cash, and I'm modifying them, fixing them, bringing them up to code because they're just goddamn slums.
I'm so glad you said that, Mike. Bring them up to code. It's a
Yeah.
big theme of mine these days.
Yeah. Well, that's with an Invitation Homes.
With a,
Yeah, actually, my guy, he's really my team. They're great. He's brilliant. He's also Max's go-kart coach, 3-time national champion. Anyway, he's doing all the legwork. Young guy, 23 years old. I gave him millions, and he's done an amazing job. So we get about a very high teens yield, unlevered on the properties, and once we lever them, because they end up being worth a lot more after we fix them up. And you just have to be really selective in what you do, what you buy.
Yeah.
And I'm looking for distressed things that are off market. And our phone now is ringing off the hook because all of a sudden we're the only cash buyer. All of a sudden, like literally in the past 2 weeks, just distressed guys because now the yields are going up and they just have to cut their portfolio. So
it makes sense.
I'm shocked how fast it turned into the buyer's market. Now it's totally not the buyer's market for single family homes. Like you want to trying to look for a property that's available, but something that's completely dilapidated, nobody wants it. Nobody has the skills to put it in. All the materials costs are off the charts.
Yeah.
So you have to be real smart. But I look at that as an arb, right?
Yeah.
Big time. That's a great. Again, it's a great way of thinking about it, right? Because if you can source materials, if you can get the personnel to help you alter that property, then you've got quite a return on your investment.
That's what I'm looking for, and I actually think the rents are. We're going to have years of 5% rent hikes or more. So, and if you buy in the right area, in the right class and everything, and I spend a lot of time looking at the map, thinking about it, because I've never done this before, but really it's just financial stuff and probability and is there a train line and all that. So, so it's actually worked out. It's worked out really well. Like, the thing is, we started this over a year ago. Because my bet was because landlords couldn't get money from their tenants, that they'd have to start selling assets because they couldn't make the float. They couldn't make their mortgage payments because 20%, 22% of their tenants are not paying, and you can't evict them. And that's what happened here in New Jersey. And that was my arb, is that I could pick off these properties from guys that had to sell. And that worked. And I'm going to look back on it. We weren't aggressive enough.
Mike, if you're looking for a hedge in the public markets to that business, check out Invitation Homes. I don't know if you've been following that, but it's an interesting one.
Yeah, I'm short every housing builder.
Okay.
Since coming into the year, because think about it, coming into the year.
Well, they're a landlord, not a builder.
Yeah, but it's real estate. I mean, they don't care. It doesn't, to the vanilla guys, it's all the same. I think Invitation is only being held up because hedge funds are just vomiting everywhere and they got to cover their short and they can't stick it out.
Yeah. Well,
really, I think that's what's going on.
I think that one gets cut in half for what it's worth.
I've been following it. It's stunning. It's one of those things that is a clear fraud with a lot of misdeeds that are clearly culpable, and there's going to be, I assume, a nasty fine to pay.
Well, Mike, you talked about the social intelligence. I'll just say it. Like, these guys are lying to people. Like they're flat out lying to people. Like when the long only specifically go to talk both to the sell side and to the company. I mean, they're just not being truthful, and I know it. So it's bad. It's not good.
Hopefully, Jim Chanos will have something. This is like right up his alley. This is like something that he will just attack. I hope he'll say something about it. But that is exciting when they're just openly lying, like Nikola. By the way, Nikola still has a $3.6 billion market cap.
Isn't it
Do you know what I looked
fascinating? I
today?
mean,
I looked today.
it's
They have
unbelievable.
900 employees. What are they doing?
They're not making cars, that's for sure.
Well, they're planning on. They have grand plans.
Yeah.
But I was
Well,
just thinking about frauds where they're just openly lying to you. It's
Yep.
like, but we're going to get a lot of that going on, just openly lying to people everywhere. I think in this market, because margins are estimated to be way too high, and they will go down throughout the year. And there's going to be, I believe, an incredible number of revisions lower everywhere. And
yeah, and
but nothing will happen until Apple chokes.
right.
Then it happens. Then
Right.
it's real.
So so that's it. That's again, if we kind of take it back to a bit process oriented here, Mike, when you're looking at oh, sorry. Actually, George has been on here asking to speak for a hot minute. So why don't I pass it off to George, and then maybe my question can be the last one. We'll wrap up. So George, welcome. So Mike, George is a phenomenal. He actually lives in Canada. I'm in Boston, but he is a fantastic IA up in Canada. George, I think you remind me. Are you in Toronto or Montreal? I think it's Montreal, right?
Yeah, I'm in Montreal.
Yeah, Montreal. Yeah, yeah. So, George, welcome. Thank you for your patience in asking your question. The floor is yours, my friend.
No problem. Thanks, Mike. I had a question really around, you said earlier today that you're not a valuation guy. So I know that Keith has said this as well. Keith uses his VAS model there, and he uses his analyst to trade around particular names. I'm curious as to what you use and what tools you use to hone in on your process.
Oh God. So my process is because you kind of sit there for long enough and watch the soap opera, and you keep up on it all the time. You know, you're listening to calls, you're doing a million different things all the time. I just see stuff.
Mm-hmm.
That's it. And I talk to my friends, and sometimes I get ideas from them that I can kind of modify or optimize and figure it out. Um, but really, my entire approach through my whole career has just been a shotgun approach, where I look at I shoot a wide shot, no choke, if you will, for all of you 12 gauge people out there,
Mm-hmm.
and so I look at everything. And I try to on shorts. I try to look for the most ridiculous ideas that are, and like Peloton. I mean, Peloton was great. That was one of the greatest trades ever. They made a machine that eats cats, and the stock didn't go down. I'm like, okay, I need to be crazy sized in that. And so if you're looking wide enough, you can see it. You have a company, for instance, Peloton, that even when the times were the best, which was a once in a lifetime event, they still didn't make money. And then their new gadget eats cats. Wow, where do I sign up? It just so happens that most of my best shorts happen to be in Kathy Wood's book too.
Mm-hmm.
So, but and that's really my process. I look for things that are impossible.
Okay.
And that's really for shorts. For shorts, I love things that are impossible. That a 4-year-old could only believe it, or a liberal that works at Princeton.
Mm-hmm. I had one more follow up with regards to.
Sorry,
You had.
Sorry, George. Go ahead.
you had mentioned that at some point, probably in this cycle, there'll be this rush into like the TLT or something, or
Yes.
everyone's going to be everybody's going to be rushing into bonds. But until we get to that point, where would you hide? Will you use gold, or I know you're not a crypto fan, so would you use gold or gold related equities, to hide some of your stash in there?
I'm 106.6% net short.
Okay.
I am not hiding anywhere.
Okay.
Stocks in general won't work, but I have key names in my book that I think are, 20 baggers, and I really want to get bigger, and I'm size in many of them, and so I'm just structuring my book so that hopefully I can. Oh, we got Mr. Max coming. You know what Max is doing? He's going on a trip, and he's digging into my wallet as we speak. Let's see what happens. How much are you going to take out of there?
Supposed to bring like, can I take like a few 20s?
No, take some hundreds. I mean, yes, because just in case you get stuck somewhere, take two. Okay.
Hey Rob,
No, just in case you get stuck somewhere, you need it.
I love it. Hey, Rob, sorry.
Always have a backup
Are you
plan,
dropping
Max.
off?
Yeah, I got to run, man. Thanks a lot, Mike.
No worries. Thank
Great
you.
talking to you, man.
It was. I'm honestly, if Keith is still on, it is an absolute honor to work with you, and you built something that is absolutely magnificent, and I'm so happy for you. And for the listeners out there, I am a premium client. I just did my taxes. I think I pay $2,500 a year to Hedgeye, and it is tax deductible as a day trader, which I am.
Well done. All right, guys. Be well, everyone. See you later.
Have a great night. Bye bye.
You too.
So, George, was that your kind of final question there, buddy?
Yeah, it's all good.
Awesome, buddy. Awesome.
Thanks.
Gavin, did you have anything as a follow-up for Mike before we kind of wrap up here?
No, I think you were heading there, Robert.
Yeah,
I was going to circle it back to ask him what the second, point to make a great PM. I think it might have been your question, Robert, or maybe Keith's from a while back, but I've just been sitting here taking notes. So
yeah, it's been an awesome call, Mike T. So thank you very much. He may have dropped though.
It sounded like he had some stuff going on.
Yeah. So he may have dropped. So awesome, guys. Well, that was a fantastic conversation. This has been recorded, obviously. Well, not, I shouldn't say obviously, but this was recorded. So I will be circling up with the recording here shortly once we wrap up. And Mike T, thank you so much for joining us. It was quite a lesson across the board. So no, Hedgeye Nation certainly appreciates your time and values your input very much. So thank you very much, and everyone who participated, joined, listened. Great conversation. And again, we will see you soon. For those that are kind of new, we do a weekly notebook review on Wednesdays. So they alternate between 4:30 and 8:30 in Eastern. So this week it'll be 8:30 p.m. Eastern time. So yeah, join back for my Spaces session on Wednesday. We kind of go through more macro setups and that kind of thing. So again, for those that are new to this process, more of a macro setup, kind of things that we're seeing that are jumping off the page to us, and how we want to get positioned going into the back half of the week and into month end, quarter end, et cetera, et cetera. So we try to take a bit more of a holistic kind of view, not necessarily on stock picks per se, but definitely on more of the macro setup. So join us in Monday. So join us in a couple nights, and then so thanks again, and look for more of these sessions. We typically do, or I do it monthly. We call it monthly market meetup. This is a special one. Normally they're on the third Thursday of the month, and we've had the last month was with Dr. Andrew Maneker. So that was an awesome session. A bit more of the psyche of trading and that kind of thing. But look for these kind of one-off, more deep dives with very special guests. And the next one's supposed to be Mike Green. So just kind of pinning him down. But hopefully that'll be actually not on the 21st, I believe it is. So not this Thursday, but next. Anyway, all the best, and thanks for listening in. We really appreciate your time. And Gavin, always a pleasure. George, thanks again for your patience, my friend. All the best. We'll talk soon, everyone. Thank you.